Have you ever had a client that had a lot of money in the bank but couldn't qualify for a mortgage? It just seems silly to you because, of course, they could buy the home with cash, but the lender's telling you, oh, we have a debt to income limit. We don't have enough documentable or usable income, qualifying income. Well, today's tip from Tara is about a solution to this problem. So the product of the week is asset depletion loans. So let me tell you what it is and how it can help you with a few more deals this year. Look, Fannie Mae and Freddie Mac have always allowed us to use assets as income, but their formula is super, super conservative. In fact, you take all the money that they have and you divide it by the number of months they'll have the loan, right? And so Fannie Mae, you divide by 360. Freddie Mac was the good one. You could divide it by 240. But the fact is, you literally had to have millions of dollars in the bank to have any kind of small usable income. So while we would use it, it is a tool in our toolbox that we use occasionally with conventional buyers. It didn't open up the doors for enough people, right? And I could see why that would have been a frustration for buyers and real estate agents alike. So pleased to announce that we are now doing asset depletion loans that are done with outside investors, and we're underwriting them here in-house at Fairway. Here's why this is helpful. The different investors have different rules for what percent of the assets we can count. So if it's in a retirement account, maybe we can use 60% of the balance or 70% of the balance to account for penalties and taxes if you were to take the money out. Or if the funds are invested, we're going to count for the stock market fluctuations, so maybe we can use 70% of those accounts. So each investor is different. Then the factor that they divide by, so the formula we use to actually take the assets and convert it to an income number varies by investors. But some of these investors are 72 months, and the most recent one I closed, my success story that I'll share with you, is only a 60-month factor. So you take the amount of cash that they have, you apply that ratio depending on whether it's retirement or invested assets, and then we just divide that over 5 years, over 60 months. And it is a fantastic product. So give you an example. The success story of a buyer that we closed today, recently divorced and could not use her alimony as qualifying income. She doesn't have a long enough history of receiving that income. But she does have assets, right? A home was sold not that long ago, and those funds were divided among the two spouses. The marital assets were divided. She actually received part of a 401k. And so the assets are there, but we don't have any income that we could document. Well, here comes the asset depletion loan. So we were able to apply the factors as I described and get it with an investor where when we used their calculation, it was exactly the income we need to get her into this dream home that she wants. So wonderful success story, and I'm excited to say that she's closing today. Here are some pitfalls that some loan officers might run into if they're not very detailed and familiar with this type of product. One is the seasoning of the assets. These loans require that you've had the money. We can document that they've had it for a certain period of time. Why would that be? Well, they want to make sure that there's not some rich uncle, for example, that would just kind of lend the money to the buyer so that they can have it in their account long enough to qualify for a mortgage and then give the money back, right? So they want a history of you having that money. And it varies by investor. Some of them are as long as a 12-month seasoning, right? My favorite investor, the one that we're closing with today, is only a 2-month seasoning, right? And this is important because with some of these investors, selling a home and having that hunk of cash does not count as seasoning, right? Even though you had the house for a long time, they want to know that you've had the cash sitting in the bank for a long time. Same thing happens when you split assets after a divorce. If it goes from being his 401k to her after divorce 401k, then the seasoning starts when the account opens in her name. Okay, so a skilled lender is going to understand all those details and make sure that this exactly works to come up with a solution for you. So look, that's why working with a true professional, someone who stands behind their word and makes sure that things are going to happen the way they say they're going to happen is so important to you. Look, if you have a buyer with strong assets, but maybe not enough documented income, we would love to help them and help you. Let's get more people into homes. So that is what you need to know about asset depletion loans. And guys, that works for lower loan amounts, also for jumbo loan amounts. Like, we can do that for any loan amount whatsoever. It's a wonderful product. We're thrilled to be able to offer it with underwriting in-house and expertise you can trust. Give us a call.